First question, calculate the profit or loss, and this question examiner is very lenient, very helpful to you. He has given you the equation. Profit or loss is equal to closing net assets minus opening net assets. Actually, if you now see, if I write the equation, profit or loss, they are writing here closing net asset minus opening net asset. If I bracket in one phrase, this is I, increase or decrease in net assets, plus drawings and minus capital. This is the equation. Now, can we have the answer, please? Already, this madam gave me the answer. 54. Yeah, that's correct. Further. जवाब गलत यानी गलत और इधर Am I making your life difficult, sir?
No, absolutely.
Now, it's a matter of using your calculator and telling me the answer. How much? If anyone is struggling from this to next level, then I need to teach maths. How much? 168. I am getting one answer, 168,500. Do you have an option there? Hmm? $180. So I am receiving now two answers. So let's take a vote on this. Who is voting 180 and who is voting 168,500? So now I have two votes here and one vote here. So one more answer. So this is the winning the majority.
180.
180. Answer is 180 only. If you want me to solve this, or that's okay. Shall I solve it?
Yeah.
Okay. See.
Just a second.
Okay, sorry. You know, in WhatsApp message, when you it comes up, several numbers come in, no? So that's it. Now, solving this, one method, one way is, one option is, simply take the net answer of this, and then we already have this answer. So here you see minus I have, here I have plus, and then here minus. So this 200 and this 700, if you adjust it, then minus 101,500, and then plus 2,000 minus 8,000, NA2 is equal to 72,500. And if I work on this, that is 72,500 is equal to NA2 minus 101,500, and then between these two it should be minus 6,000. And now what to do is, see, this also minus, this also minus, so NA2, so minus 107,500. Is that right? So is equal to 7. Next question. On the next one, 3.4. If I receive the correct answer for that question, it will be really great. Can I erase the board
Yeah.
for everyone? You okay? You want me to explain? Erase it fully. Sir? Okay, 3.4. Can I read it to you in your phone? This is 3.4. Is that okay? The profit made by a business in 2017 was 35,400. How much is profit? 400. And also please remember the terms they use. They say here profit. So that means this number must be plus. And also from a mathematical point of view, if you write a number without plus, it means also plus. So next, if I continue that.
The injection capital of
The proprietor injected new capital of 10,200. So
this one plus.
CI is
X plus
10,200.
This one plus.
We will come to that. Yeah, this also plus. Correct. So that number also plus. Next one.
Withdrawal a monthly salary of 500.
Yeah, withdrawal monthly salary of 500. That is drawings. 500 per
Minus.
month.
That will be minus.
Yeah, we will form it. And then what else they say? They were saying some more information. Can you please open? If the net assets at the end of the year was 95,100, so that is NA 95,100. The question is, what was the proprietor's capital, meaning net asset at the beginning?
NA1.
NA. This is what we need to solve. And we know that we have one golden equation, P is equal to I plus D minus P is equal to, instead of I, NA2 minus NA1 plus D minus CI. Now we just substitute these numbers here.
45.
How much?
45.
Your answer is 45,300. Okay. So 1 watt.
126,300.
How much?
126,300.
126,300. Another 1 watt. For two different reference. Calculator? Supposed to be, right?
I have no idea.
No, it should be.
Maybe we can try from this.
No, I don't need now. We will not waste our time.
1 month. Every month or 1 month?
Per month, yes.
Every month.
Yeah, per month means every month, yes. problem is the knowledge of English is also one problem. Okay. Tell me whether they want. Okay, that is net asset at the beginning, huh? Okay. So two watts. Now, how much is profit? Profit was 35,400, and the net asset at the end 95,100. And this is what we don't know. Drawing how much?
6,000.
It should be 6,000. That's the catch here.
Yeah.
So it should be 6,000. And the capital introduced was minus
10,200.
10,200. So if you really simplify all this, your answer should be 55,500. Clear? So with okay, now I need to discuss an additional little bit of that part of it. Then we can go to costing. If you allow me to erase this. Yeah, we understood operating revenue and non-operating revenue we discussed. And then we also talked about operating expense and non-operating expense. I received a request to elaborate little more on capex and opex. Yeah. Now, the real word is capital expenditure. How I define capital expenditure is any expenditure will increase the amount of revenue or economic benefits that will generate from the use of an asset. That expenditure is capital expenditure. If I had to tell you, give an example for that, I have a piece of equipment sitting in China. We know that equipment, now let's say my business is a factory. I need a machine, and this is a machine that is now sitting in China. Let's say the selling price is $10,000. What we do, we open a LC or we find a way to transfer the money, and I have sent $10,000 money received to Chinese company. Now, the moment you have paid the money, the very next day, would you have that equipment in purchase price? We need to incur something called directly attributable cost. The meaning of the word directly attributable cost, if you don't incur that, you will not have that asset with you in your possession. Good example, you say that, my friend, I will not pay the insurance. You send an email to Chinese factory or Chinese the supplier, I'm very sorry, I'm not paying the insurance. They will say, thank you, no problem. Let your piece of equipment sitting in my factory and I will not ship it. Or if you will tell, I will not transport from the missile port to industrial area. Let's say agreement is only about 10,000 in that situation. Yes. So now what I am trying to explain you, what is the meaning of the word directly attributable cost. Another example.
Logistic
Yeah.
cost.
Example related to our work.
Yeah.
This is, it doesn't make sense for me.
Now, from a real estate business point of view,
Yeah, we are renting property,
yes.
it's fully furnished.
Hmm.
So this is basically what we, how to segregate this from this.
Fine. We'll talk
Yeah.
from the point of view of real estate property.
How to, yes.
Okay. Let's say you have a real estate property A.
Yeah.
This is property A. Sometime your company may newly construct this property. You will have a bare land and you will construct.
So that they construct.
Yeah, I'm just giving scenarios. So one scenario, from using an empty land, you will construct one property. So the cost of that construction also part of capital expenditure. That's clear. Question is, there is from your trade, there is a term everyone knows this term, right? So, question is, just you completed the construction, can you accommodate your tenants to the house? It will not be possible.
No.
They will not be happy. So, they would expect you to complete the furnishing also. So, you may have to either purchase furniture from a furniture supplying company, or you may have to bring technician and you may have to in-house build the furnitures. The room or sofa or cupboard or whatever you call it. That also part of your capital expenditure. Now there is a different question or thinking may develop. Life of this asset. Now the life of the building, let's assume 50 years. What do you think the life of the furniture? Will that coincide with 50 years? No. Exactly, 2 years. Meaning, what I wanted to say, it is not this 50 years. It could be 5, 10, 2, anything. So, for the sake of simplicity, I take 10. However, the cost of this and the cost of this, I cannot take into my income statement as an expense. Why? I will not be able to sell my property to my tenants only with this. So, this also part of directly attributable. That's again a concept may differ. If you say that I am giving you unfurnished property, but again AC or ventilator, some minimum furnitures, you may have to have it. So that depends on the contract that you are having. But you may have your own benchmark equation. Our property, this is what the setup is, or this is what the equation is. Accordingly, you have to consider these are my capex or these are my capital expenditure. Now, from your business point of view, let's say one property D, suddenly you receive a request that you need to renovate your washroom. There are in this property, let's say 50 washrooms. You have to renovate the washroom. Question is, this renovating cost of the washroom, is it part of capex or opex? How you decide? You just open the eyes and say capex or opex, or there is a criteria. Okay, one answer he is saying amount. Any other criteria? Lifetime. Any other criteria?
If I spend this money, the value will, or the asset will increase or not?
More than that, you need to ask the question. That is the main question you need to ask. By incurring this amount of money, am I enhancing the future economic benefits for a period more than 1 year? If increase, then that expenditure is capital expenditure. if that expenditure is not going to justify such an increase. Now, what do you call that? Color wash. You make a paint to your property. I'm just speaking example from a general scenario. Color wash is an operating expenditure. But color wash, painting. So painting is an operating expenditure. But now washroom maintenance. We'll come to that example again. Now washroom maintenance, by default, I need to have a certain standard washroom to every single tenant. If the bidet shower is broken, and if the responsibility is with the landlord, meaning the property provider, now installing or configuring or setting up another bidet shower, you cannot consider that as capital expenditure. That will be operating expenditure. But if you had to renovate the entire washroom, remove the tiles and then open up the pit and all this, that will lead to capex. Now the principal problem here, it's a matter of management call as well. For me, something can be operating expenditure, which for you can be capital expenditure. I'll give an example. This Abdul Ghani, they are selling vehicles. Now buying a car from Abdul Ghani point of view is not a capital expenditure. It is not an asset for them. It's a trading stock. But Al-Mufta real estate company or Al-Mufta contracting company, they go and buy a car from Abdul Ghani, and that for them is a capital expenditure. So coming back to our scenario, this renovating your washroom or one portion of the property, depending on, this is the last criteria. Amount is the last criteria. The very first criteria is to ask yourself, this payment is going to increase my, I'll give another interpretation. Let's say I have the property working at 70% efficiency. It was like 15 years old asset. It is normally working and I am receiving certain rent. No problem. One fine month, there was a damage. And suddenly this dropped to 40%. So certain tenants, we need to vacate, we need to close the such property, we need to do some renovation, all this. At that time, I am not receiving any rent. So the efficiency level is gone down to 40%. Now what I am doing, I am incurring expenses. This expense can lead to two possibilities. One, it could come up to 70%. It will not be 71. It can be 65, 68, 70. Second scenario, 71% or more. Now I believe you understood how you define what is your capex and what is your OPEX. If that payment is coming to this result, that payment should be OPEX. But if that payment you justify with financial numbers, then that is capital. So in a real estate property scenarios, one of the major issue is that renovation, maintenance, and also certain acquisition. So these three. So in these three, you just need to simply apply that phrase. I believe this clears the context. Or any other question you have?
It raises more questions actually.
So basically this is for us to decide.
Obviously, but based on that
Justification.
That's the equation.
So it could be
See, management expense, it's a judgment call. It's a judgmental call. If you justify saying that no, it is only 60% I'm going to get from these expenses, I have to charge that to P&L. But if you justify to management that it is providing better, then you capitalize that.
Buying a company vehicle to transport staff is a capex.
Of course.
It's capital.
Yes.
Regarding this okay, I will do a full refurbishment for one.
Then that is definitely capital expenditure.
But for one washroom in an apartment,
Yes.
in a building with 200 apartments.
Yes.
So this is something I'll go back for the amount.
Then you need to work on something called materiality threshold. Meaning of this, calculator. You see, if you see your office, you may see in the table a calculator sitting there for last 10 years. And then if you go back to the definition of non-current asset, what we said was, any economic benefits exceeding 12 months, I should capitalize. But I have purchased this calculator from Jari bookstore for 80 riyal. So then I should be capitalizing this. That's the question that is going to come to my mind. But then, in this situation, company must have their own capitalization, materiality threshold. Any payment above this level, I will capitalize. Anything less, I will write off.
But this in buying something, okay, a mobile is 1,000 riyal. It will be always an asset,
Yes.
even it's 1,000 riyal.
Mm.
But this refurbishment of the washroom, okay, this may cost me 15,000 riyal.
Correct. Well, it is again company's policy.
So the
If you
cost
buy
of
a single one mobile to one salesman, where you have like 100 salesmen, and that 1,000 riyal could be considered as a lower than the material threshold.
so regardless the nature of the item itself.
Yes.
Okay.
One of the point is materiality.
And then a mobile will be considered as an asset.
No, you write off.
You write
No,
off.
you write off. You will consider that as expense.
Expense.
I just need to go back for this refurbishment.
Yes.
Okay. I'm refurbishing
Yes.
the full washroom. Okay.
Yes.
I will pay 15,000 riyal.
Yes.
But again, this will help me to rent this apartment.
Correct.
So the overall revenue
Will increase.
will increase.
Then
For
you
sure.
justify.
But at the end, it's one washroom, one apartment out of 250 apartments.
Correct.
Still, it's an asset.
Yes. Definitely. So the criteria is what?
But if I just change the flooring tiles, this is OPEX.
No, that's a different story. Now, let's say computer, you change the what do you call that, the capacity, CPU, you hard disk from 512 GB, you change it to 1024.
Upgrade.
Yes. Then that will last long. Then you will consider that as a additional benefit that is going to generate. But if you just buy what you call PC or only a monitor, then that's a different story. So that's how you gauge yourself.
Judgment.
Yes.
I'm saying that this is a judgment.
Correct. It's a judgmental call.
Yes.
For one company and another company, also size of the company matters. Now, let's say you go to Salwa Road, one is small real estate company and your company, for them the capital expenditure, for you it's not. It's the parameter that matters. Fine. So,
Who will judge this?
Excuse me,
In
at this
my
point.
point of
Yeah.
view, in my point of view,
Yes.
this can be a capex. Financial item, goes to finance, they will say this cannot be capex. So who will
see,
judge it?
that's exactly then you have to go with the principle of whether your point of view is collaborating to the point of enhancing your revenue. If you can prove that this payment that I am making is definitely my rental income is increasing more than what I received in the past, but with more than 12 months.
But my income will not increase, but I will reduce my expense.
Same thing, economic benefit doesn't mean that
So I'm doing this. By doing this, okay, I'm fixing one problem.
Yes.
I have one problem. I'm fixing this with a permanent solution. So I will not. I used to spend every month 10 riyals, but by spending 200 riyals, let's say, I will fix this permanently. I will not spend this 10 riyals
yeah,
at
then
all.
you are saving that.
Yes.
And then there is a financial management calculation you need to do, and that will result into a positive number for you. then you justify that there is an increase in economic benefits. Economic benefits one way, increase in revenue, another way, reducing the cost.
Going back to this example of my ocean.
Yes.
So we said if we do the foreign immigration, it will make capex. If we do cash, let's say we replace it.
Only
With the same,
yes, yes,
500 million.
yes.
At the end of the year, we'll have 30 things will change.
Okay.
This is part of the.
That's
thing
when
we are doing.
we need to talk about. Normally,
But
I will
it's-
consider
Yeah.
I will consider this example as an expense, OPEX, normally. But if you have done significant numbers,
Change for all the towers.
yes, then also in your balance sheet, how do you have shown your asset, this property? when you see this, see your property may have several line items. One is building. Another one is fixtures. So you are not worried about doing something for this washroom. Is nothing to do with your building. It is about your fixtures. But then if you have line items within the fixtures, then the materiality will be different. If the total equipments in a given washroom into 1000 washroom, let's say one washroom, commode, sink, bidet shower, and this everything, let's assume 2000 riyal. And then you have 1000 washroom like this, are going to be 2 million. This is what the finance team, what you're going to do, you're going to pick only one and then you need to change this. Then obviously that is immaterial, you will write off. But if you will do of this 2000, if you will do for let's say 50 for example, then the number is sizable. Because here the change is going to happen on this 2 million. It's not going to be like 300, 100, 400 like this. They have clubbed it into 1 million. So that's the scenario.
We will stay here for a while, I know.
Yes.
Because this is what we are facing daily.
It's done.
Alright.
Yes.
Okay, all our contracts, let's say, all our leasing contract is minimum 1 year. So at the moving of one apartment, I will go and make a reupholstery for all the furniture.
Yes,
And by default, it will last more than a year
correct.
because the contract is already at least 1 year. This is considered as
No.
reupholstery. I'm not buying new furniture. I'm refurbishing the existing furniture or changing the fabric.
Any required changes you will do to existing furniture before you
The new tenants
giving
move in.
to new tenants.
Yes,
And then tenant will sign for 1 year contract.
exactly.
And this expenditure, how I deal with this is the
It's
question.
furniture. That's what I'm saying. It's something.
You don't furnish it, but what you do is you refurbish the existing furniture. Maybe one sofa you will change the cloth,
Yes,
or you will
exactly.
change the
Exactly.
cushion, or you do something like this.
Yes.
And then you go back and ask this question of the 70% question. If that, I hope everyone knows the meaning of the word efficiency. There is another word. The difference between these two, everyone knows. There's one famous management theorist has defined it in this way: doing things right, doing
Seconds.
right things. Now, effectiveness meaning the result. At the end, I need the outcome. So that is doing right things. This is effectiveness, which is doing things right. That is efficiency. Anyway, coming back to our discussion, when you do this type of expenditure in enhancing the quality of your furniture, if that quality remains at the previous condition, then you write off that amount of payments as an OPEX that needed to be written off to your P&L. But if you justify, no, it is going to increase significantly, the other problem is the rental contract. After 1 year, another new tenant comes, then again you need to renovate, then no question, this entire amount OPEX.
So basically for you to decide for the furniture or whatever assets you have, if you want to keep the value, how the value deteriorates, you determine that and you do the expenses.
More than, that is one gauge. Other gauge is using this particular asset, how best I am generating income or saving increasing, or the cost is reduced. Like we took that example of after fixing that device, my daily or monthly cost of 10 real is gone.
Future economic growth.
Yes,
So we need to decide.
correct. Now when come to financial reporting,
It's a dialogue at the end. It's
see,
there is
when
nothing.
come to
It's not,
financial reporting in a company, every company must have something called financial policies and procedures. Like machineries, they have something called
Operation
SOP.
maintenance. Operation maintenance.
Yes, that is ONM.
Yes.
That is ONM, standard operating procedure.
Yes.
For financial reporting also, there is something called P&P, policies and procedure. So every company must have their own document. This is something like a Bible. So when you face this type of situation, this is not the finance team or the operating team to decide, it is the P&P to decide. But other question is, who is bringing the P&P? P&P is brought by the top management, board of directors. Maybe they may hire external auditor like Pricewaterhouse or someone, they will write it and they will charge 200,000 reals, and that will then taken to the board. The board will read it and they say, okay, approved. And that will be the document to follow every single example of your business nature. But in absence of that, that's when the dispute starts. For the finance team, they may have one argument, and for the operation team, they may have another argument. But at the end, there's something called goal congruence. Both of the team working for, finance team is not working for their own benefits, neither operation team also. It's not for your personal benefits. You just try to save extra real to the business. So, find out what is the best policy. If the finance team is saying something, you please question them, do you have a policy? If they say yes, ask them to share that. If they say no, then
We have to refurbish the furniture every year. It is an operation expense. But doing this year, I can, renew the tenancy contract for another 2 years.
then because of this renovation, you are able to renew the tenancy contract for next 2 years. Then you should write off this expenditure within the 2 years.
As a capital
Capex, yes. And then you will write off into, meaning you will depreciate in 2 years.
But in the operation, real life operation, this will be decided before it becomes done.
Exactly. That should be a policy. I said, see, policy is the very first thing. Day one, year one, should be there. And then on the ground, when you start implementing or facing real-time issues, you just refer to this P&P. Whatever the P&P is saying, follow that. Strictly follow that. And remember, P&P must be changed regularly. I won't say every year, regularly. Maybe accounting standards may change, maybe the country's law may change, maybe the senior management may change. Due to all of these factors, you know, the experience of the senior management is also different. Maybe you hire one CEO, he has no experience in real estate management. And another CEO coming, he is very impelled in real estate. So the delivery of these two CEOs is different. I am not criticizing this person or I am not favoring this person. Two different skill set. Yes. So
All the BNPs can be created as per the current market sector standards,
See,
best practices.
it's like this. It is the PNP also a collection of different individuals' experience based on that company. There is another word. Benchmarking. If you don't know or don't have, you just different follow. Like when I come to Doha New, I came in 2003. That time the huge malls or supermarkets are City Center is one, then Lulu, then Family Food Center. City Center only the mall also there. But we have never been to mall. Our mindset was mall is one of the expensive place to go. Many times I crossed that area, we don't want to see. It was created a fear mindset. So we had city center for fancy visiting and shopping, then Lulu and Family Food Center. This was our choice. But now, then later, for example, let's say Paris Hypermarket. Now Paris Hypermarket, Lulu, Family Food Center are all from the same country, same regional people. So when Paris Hypermarket wanted to set up their business operation, they will follow Lulu and Family Food Center. This is what I mean benchmarking. And gather the experience of different experts in the business. Now, old school of thought, new school of thought. If a business is introduced by grandfather, he may not have understanding of the modern way of doing business, but he will be the expert. He will be maybe a doctor. Now everyone I believe know Umar Al-Fatah. He is the expert for pearl. And if he takes the pearl in his hand and he gives the value, no machine, no equipment, no device can challenge. That's the value. So that is the expertise what I am talking about. So you get all, put down into paper and rubber stamp by the senior management, that comes to PhD and then we stick to that. You see, even to that extent, when we talk about IFRS, what is the full form? International Financial Reporting Standards. Think about 40, 50 years before, globalization was there or not there? So we are limited to our own country. And not only that, we are limited to our own village. And maybe 10, 20 family only having their own social attraction. So later, that time we had something called barter system. Then money introduced. Then transport developed. It was land transport, then sea transport, then air transport, then all this transportation came. Then communication also developed. Those days only post. Now, within seconds, the messages across everywhere. So because of that, our knowledge getting more exposed, and then we can have. So when we developed IFRS, what they have done, of different experts sitting around the world. Same thing, in a company, you develop your policies and procedure, you get that knowledge from, you share, call all the, operation heads. Tell them, write what you think best. Then Mr. A, Mr. B, or 20 people will write down. And then this put together in the board. And the board then will go through some good, expert can gather, accumulate, streamline it, order it, put it into a format, and then name that as policy.
We don't have the policy. The BMPs we don't have it.
You do have?
So, which means now
financially wise, it can be also capex, but capex is just based on the decision of the management.
Yeah. Fine. Can we
So
proceed?
financially, I mean,
Yes, sir? Okay. So we discussed about this. So this one, that is more applicable to people who sell goods. So, for example, my cost of the good $10, selling price $12. And then I sell 5 items. So my sales 60. What is my cost? 50. And in this one, very simple terms, cost of goods sold. It may go into different extent, but I don't want to discuss. So if you go back to this slide here, the direct cost of producing goods or services sold by the company, raw materials or labor. Administrative expense, which are salaries, rent, electricity, water, those things. Depreciation, we talked about it. Now, what is amortization? Now, to understand amortization, when you say asset, I have two types of asset. Tangible, other one is intangible. For tangible, I have depreciation. For intangible, if my intangible asset's life is limited, then I have amortization. If it is unlimited, we don't have amortization, we have something called so this is same like depreciation. Amortization is same like depreciation, provided that has a limited life. Example, someone told me brand. You will sign up a contract with the brand owner, not for next 100 years, for 5 years or 10 years or 20 years. So that 20 years, how much money you pay, that is the limited life intangible, for which every year you need to amortize. But if you have some intangible asset which you don't have a limited life, good example is goodwill. What is goodwill? For example, you know the chicken. When I thinking of or craving of eating a chicken, what is the name comes to our mind? What's the name comes to our mind?
KFC.
See? Okay. Maybe next in the road next to my house, there is a good small restaurant making the same chicken even more tastier. But me or my family will say, no, we don't want to go there. We want to go to that KFC. Because of that, they carry that name. Audit. A large organization, when they think about auditing, they will only say EY, PwC, KPMG or Deloitte and Big Four. I have seen. Now, even I am ex EY and PwC. Currently, I am reading some. I am not criticizing this, but currently I am reading some of their financials that is worse than a normal audit firm. The problem is not the owners of Ernst & Young. What happens is the scalar chain. There is a super trainee, super junior, junior, normal auditor, senior auditor, supervisor, assistant manager, manager, deputy director, partner. What happens is This guy is the main person who is doing the work. And all of these fellows are reviewing. And if anyone here missed the proper review, then that will go to the customer. Customer also will not know because he is not expert in that amount. Problem will come when this financial needed to be used by a bank or some another government or someone to review, then they will find out, oh my goodness, what is this? I have seen many such financials. So, brand, that is because of the brand, Ernst & Young. So, whatever it is, we go to Ernst & Young. So, regardless of the outcome, regardless of the quality, the name is still capitalized. So, that is what goodwill is. So, if I have the goodwill, that is one of the examples that is for the long time. Now, I hope every one of you know Enron. Do you know Enron? Heard of Enron? When you have free time, go to Google and search Enron. This is one of the 7th largest power generating company in the world. Auditors for this are Arthur Anderson. Previously, we had Big 5. The 5th one is Arthur Anderson. But the Enron managing director, the board of directors have done a big chaos here, and they approved that. After approving, financial came out, and the shareholder went to courts, and that they found guilty of the senior management of the board of directors and the auditors. And the court said, no more Arthur Anderson, no more Enron. So then, in Middle East, what Ernst & Young did, they suddenly went and captured all the audit files and the staff of Arthur Anderson. That's why in Middle East, Ernst & Young is number 1. So, that type of danger also. Yeah. So,
It's more applicable when there are more shareholders.
exactly. So, corporate governance, best practice, that is, we will not talk more here. So, anyhow, so this, I think we talked about this. This is one simple example or screenshot of how a balance sheet will look like. Property, plant and equipment, typical. This is not the exhaustive. It may change. Property, plant and equipment, inventories, trade and other receivables, cash and cash equivalents, capital, additional contribution or capital additionally introduced, legal is one of the other reserves, return earnings, and non-current liability. I hope everyone knows this, end of service benefit, and then current liability. So, that is a general snapshot of balance sheet or statement of financial position. Now, there is a word called liquidity and solvency. How to understand that? You remember in that video, they said that, okay, I will add one more word here. Is it fair to take up all the business which will be always profitability? Should we take it? No. We should not be taking it. We should be looking at these two aspects also. What is liquidity? How sufficient liquid funds available for me to manage my business? What is solvency?
Paying the liabilities.
Pardon?
Paying the liabilities.
Paying, yeah, that's one simple explanation. How strong my financial structure to manage my liabilities? Now, if my total assets 100 and my total liability 150, that means I'm insolvent in other words. It should be maximum. So there should be a balance should be stricken between liquidity, solvency and profitability. It's a triangular. So profitability, liquidity and solvency. Always this triangle must be managed. The one thing will more, it can easily blast. And there is a word called heard of this word? I'll give a different example. You find a carpenter. He busy making some repair to the table. He's having a nail. So he keeping the nail here, and with a hammer he is hitting it, and by mistake his finger get damaged. Okay? If in such speed he will hit, the finger will get swelled. And the normal finger size, like this, if the swelling of this finger, this big, is it possible? Compared to the total 5 finger and the normal size of the finger, and if the swelling is this big, how long this swelling will last? Minutes? It will last. Correct? That's what overtrading means. Without understanding your normal capacity, if you take up projects and there is no sufficient manpower, there is no sufficient resources, and there is no sufficient physical cash, you take up blindly just to keep your superiors happy. You go and collect all the projects. Within months, you will collapse. That's what I mean over trading. So, the best way to manage this 3 or this triangle. This is income statement. So you have your revenue, your direct cost, and your normal other expenses. And after this, you also have something called, which when we discussed some question, I said I will do it later. That is to do with something called here we understood. We need to have our cash flow statement prepared according to IFRS. So according to IS1, we need to prepare financial statement. And I said financial statement has 1, 2, 3, 4, 5 segments. One is statement of financial position, which is balance sheet. Other one is income statement, which is P&L. Third one is cash flow statement of business. What we are going to do here, and anyway, I'm not going to discuss the technical detail more, but I'll just tell you in a snapshot, a nutshell, what we're going to do here to find out how your cash flowed from beginning to end. At the beginning, if your cash is 100, at the end it is 200, meaning 100 increased. So this 100 went up to 200, a layman saying that there is a plus 100. This could also possible plus 200 minus 100. Yes or no? So you need to tell your shareholder this detailed breakdown. You are not going to tell the shareholder. See, if you see the balance sheet, see here, you see here. Last year how much I have? 1394761. This year 1307623. So there is a reduction. I can easily tell this to shareholder. But the standard is saying no. You go into very detail and tell them the individual layers of the cash flow. There are 3 headings. The 3 headings you need to elaborate. One is operating cash flow. Second one is investing cash flow. Third one is financing. You need to break down. So with this we'll go for a small tea break and we will continue. In the website. Yeah, that sometimes to find from this very difficult. So type in Google, you will find it. Download that and then just spend some time, 5 minutes, 10 minutes, try to understand. So, no, that I'm not talking about that. I'm talking about the financial policies and procedures. That's again confidential. So,
I'm not sure. It's not confidential, but probably nobody asked for it before.
just see whether you can. No, it should be available. Financial statement, yes, I understand it's confidential.
Anything you put financial before, it's always.
You take a
Yeah.
step back.
Yeah.
So you look like this fellow as an alien.
Otherwise, finance will not have a real value.
The mindset of the now, I also worn the jacket of an accountant and then looked your side of people as our enemies.
Yes, that's the
And the operation side people think these bugger living because of my effort.
yes.
Which is true.
Yeah. So then there is always no gelling.
And actually, leasing is saying the same about everyone in the company. It's only
Yes.
the real estate.
Yes,
So, but the reality is, as I told you earlier, there is something called goal. There is 2 words. Not goat. I hope, I don't know how many of you watched the movie called Goat.
Yes.
All of you watched?
Yeah.
Unfortunately, I did this.
Yes. Unfortunately, you are not enjoyed.
Greatest of all.
Yes. Greatest of all mistake then. Anyway, so this word is goal congruence. There is another word. Have you come across this word or this is the first time you are seeing? Please raise your hands if you see first time. And even the second word also. Okay. Let's think about house. Based on my drawing skill, this house has 3 rooms. This room, finance, HR, and this is operation. And here, and let me say here, shareholders. What the shareholder is? Is shareholder need to bother about who this Tom, Dick and Harry here? We don't need to bother about. What is his main interest?
Business.
Yeah, business and profit or money. Actually, I would say their interest is increase in wealth of individual shareholders. That's what their interest is. For you to increase the wealth of shareholders, what you need to do, you need to do 2 things. Either increase the profits of the company or increase the share price of the company. If one of these 2 happens, his wealth will increase. So, his expectation, the shareholder's expectation with this concern in our mind, regardless of who you are, all of you guys just work for my objective. Correct? So, at the end of the day, now what happens is, we are looking at only this, and vice versa applies in all of these scenarios. This fellow, what he tries, whatever the action I will take, only to jeopardize these two fellows. And that action is not with the intention of enhance the profitability or the share price of the company. Maybe sometimes 5%, 10% of the time chances are there, that may happen. But their original intention or interest is to squeeze this department. On the other hand, when you go to operation, what nonsense, fellow, oh, this bugger is trying to teach me a lesson, let me teach a different lesson to him. So, he will take another action, jeopardizing his existence. Ultimately, who is suffering? The entire company is suffering. Which ultimately, this fellow is suffering, or the shareholder is suffering. So what the goal congruence is saying, ignoring your personal interest within these boundaries. Look into the overall business interest of the company and work for that. If you work on that basis, sometimes you may have to compromise some of your personal desire, some of your personal expectation, some of your personal aspirations. You may have to forego. And then that business call comes in to say that, okay, this year operation says we need to have 20 marketing team. We think it's too much, we only have 5. But in fact, if you have 20, that will increase 25% market share. I'm just giving some tentative example. If we understand that, and if we agree with this, and then go with that, the profitability will increase, which can jeopardize his bonus. Why? He has increased the budget. That's what I'm saying. Ignoring or not personal aspirations, work for the betterment of the overall company is what you call goal congruence. On the other hand, what is sub-optimization? Let the organization be cullivally. I don't care. Only thing I am worried about, my salary, my bonus, my car, my petrol, and all about me, meaning my department. I will not compromise a single percent, whatever it is. Even the email comes from the CEO, I don't care. I may not say direct to him, but in his absence I will say go to him. I will not do anything. I will just preserve the best interest of my department. This is what I mean, sub-optimization. This is very dangerous, and this is a very good action. So, as an overall organization, everyone must have that. Anyhow, we will now move to financial statement analysis. We just understood income statement, balance sheet, cash flow statement, and we also understood the basics, analogy or the equation of accounting basis. Actually, at the beginning I talked about concept. I only talked about one concept. Remember, there are several concepts. If you can spare extra time, read on your own. I can personally share materials. Also, I do have my own YouTube channel. That will also help you in in understanding more of these topics. All these topics, lessons have been uploaded there. My YouTube channel is, this is the name, GBS Kelly. So when you have time or when you have interest, look into that. So come back to this. Now, okay. Stop which was my sales of both the companies same, and my profit both the companies same, but in between numbers different. So how I say which company is good? This is one scenario. Another scenario. A 10 times the sales of B. Profits 3 times the sales of B. Which company is good? If you independently, without comparing with this, if you independently have to make a decision, that we name it absolute. We just say A makes a profit of 1,500, that's it. This is known as absolute review. But it's really important to have a comparative review. Now, if I ask you a question, how tall this line is? Can someone answer? No. Okay, that is in measurement. Is it taller or shorter? Yeah. If I have another line here, then I can say that this is small. This line A is smaller than B. But if I have one more line here, C, and then A becomes bigger than C. So always, in order to understand the performance or the status of a company, we need to have a comparison. We need to do such financial analysis. So that analysis there are two types of analysis. One, we call it horizontal analysis. Other one, we call it vertical analysis. So what is horizontal analysis is, let's say I have A, B, C. Gross profit 70, 80. So to compare which company's gross profit is good among A, B, C, I am comparing horizontally. Or I can also rephrase this: year 1, year 2, year 3. Sales 5,200, 6,100, 3,400. So the sales increased and then dropped. So this type of analysis on a horizontal basis is what you call horizontal analysis. Also, there is another type of analysis, we call it trend analysis. That is also similar to horizontal analysis. What has happened over the last several years? Now, you draw graph using Excel. So, like this. That follows a pattern, you see? So, this is horizontal analysis. Now, what is vertical? Sales 1,000, cost of goods sold 400, so gross profit 600, expenses 300, so net profit 300. Now, GP, what percentage of sales? 60% of 60% of sales. NP, 30% of sales. Cost of goods sold, expenses. This type of analysis on a top to bottom basis is, we name it vertical analysis. So in this analysis area, the main segment is ratio analysis. Ratio analysis is very, for any profession, any business, we always talk about what is the NP margin and what is the GP, what is the saving percentage, like that. Before I go to that, I would like to ask you the question. We all know the difference between these two terms. Okay, forget about markup. Let's forget for the time being. Generally, we all hear this term, right? Margin. We hear this term. So, what do you mean by this term? Now, if I write this example, sales 1,200, cost of goods sold 600, and my gross profit 600. Now, how much is my margin in percentage? Very good. Now, how you calculate it? What you have done? You have taken 600 and then you divide this by 1,200 and then you multiply it by, this is a simple calculation, which gave you 50. I got it. Good. Using this, if I ask you to calculate gross profit against the cost of goods sold, what is the percentage? 100%. Correct. Which, how you calculate it? Gross profit is 600 divided by cost of goods sold 600 into 100. And this 50, the name we give margin. And this 100, we give the name markup. Meaning, if your percentage of profits is based on the sales, that is margin. If your percentage of profit is based on the cost, that is markup. Please keep that, understand very clearly. Maybe not here, it will be interchangeably required in your day-to-day life. So coming back to ratio analysis, I divide this ratio analysis into 5 headings. First heading, profitability. How profitable the company's business are. Second one is liquidity. How strong the liquid situation of the company. Third one is efficiency. How efficient our business is. Fourth one, long-term solvency. I have a different name here. The letter is changing to Arabic. Short-term solvency. And the last one, capital ratios. So if anyone knows all these 5 categories, then you are the master of this ratio analysis. Now let's go into individual headings. Can I erase this? I will erase now. In short, we call it Rosie. So you can easily remember that girl who looks like Rosie. You know? So return on capital employed. That is a very top ratio. It speaks about the profits or profitability of any given company. What is the equation? Profit before interest and tax divided by capital employed. Now, this number is what? Now, you remember we talked about income statement. We start with sales, then cost of goods sold. So, then we have gross profit minus expense minus so for that this answer is interest, then you have profit before tax, then minus tax. This number is profit for the year. Now, to calculate return on capital employed, I need to pick now what is capital employed? You remember we learned the accounting equation. My accounting equation is this is my basic accounting equation. Now, the total assets contributed by owners, equity and loan capital. We know that equity we have a different name, capital. So this is owners capital and this one loan capital. So alternatively I can say that the total amount of capital employed in the business is the total of this. That I will bring it here. But more deep into this, there is small nitty-gritty here. I have my total asset is equal to equity plus non-current liability plus current liability. How they will calculate? They will take this number other side of the bridge. Then what will happen? Total asset minus current liability, and this one is the total of this two. Correct? That is, sometimes examiners or some books will do. But to be simple, you can take. So this is the main equation which you need to know in calculating ROC. What ROC will give you? We'll think about that. This is the equation. How to interpret? Or what do you mean by this? I have total investment in my business, which this year given me this amount of profits. How good that is? Last year my ROC is 12%, this year my ROC is 15%. Happy. Last year ROC is 12%, this year ROC is 9%. Then there's something wrong. Or project A, project B, project C. Or property A, property B, property C. You can find out, see, along with absolute number, you cannot complete or confirm or conclude that this property is doing good. You got to have relative number. What is the best to measure? ROC. Find out for that particular investment of this property, what is the profits they generated. And also compare with other properties and have one Excel sheet. There is something called what is that? Excel template dashboard, Excel dashboard. There's a new concept. There's a Power BI, right? Power BI. So if you have that template, that will calculate this like this. It will pick the information from the linked data and then you can get the answer. Also Power BI is another tool from artificial intelligence. So now you really don't need to calculate. You just say that Siri, calculate ROC. Finish. So anyhow, this is the first equation.
Just to have to reflect this on our business. I guess.
Yes.
So I would say here the profit before interest and tax. This is the sales. I would say the rental
Rental
value.
income
Rental
and
income.
all that expenses
All
which
the
we
expenses.
discussed earlier.
So let's say this is 100 million. I have 30 million expenses, so I'm having
70 million as
profit
this line.
before, yes, 70 million.
this line. And I believe your property business may also have loans.
But here in this equation it's before interest and loan.
Yeah, that's what I'm saying.
But if I'm going to put it here, the capital employed here will be the value of the asset.
Predominantly that property is value only. You cannot take the total. If you
I
take the
understand.
total of the business,
No,
the
no, So in this case, this capital here, okay, I'm having a property that is worth 500 million,
Yes.
but I paid only 200 and 300 as a loan.
Loan capital, yes.
So I put here the 200 or the 500.
No, 500. See, equity plus liability. Total capital employed. That's what I elaborated to you. The capital is are two segments. Owner's capital
Although
and...
the interest is not calculated.
Pardon?
Although the
Yes,
interest
the
is not
loan
part
interest
of.
will be part of current liability and that you will subtract.
Okay. Okay. So this will be, let's say, 70 million
Divide
on top
by
of 500.
500. How efficient your property in earning profits utilizing that available capital for you. Is that clear? Brother, clear?
Yes.
Good. So next ratio, can I erase all this? Yes, brother, can I erase? So, next one, 2. GP ratio. Again, from your business point of view, your GP will be rental income minus direct cost. Now, how to calculate GP now? Just put some numbers, 100, 30, 70. So 70 divided by 30. And again, this you should compare with last year or with similar other project or in the industry to find out how good you are standing compared to others. So this is key. So equation is gross profit divided by sales into third one. Pardon? Income, rental income. Sales is a common term. Turnover, revenue, income, all interchangeable terms. Now, how I calculate net profit ratio? That also very simple. Net profit divided by sales into 45 over 100 into that is
Expenses here, salaries.
yeah.
Coming expenses or direct cost?
There is a possibility of falling into direct cost and also to other expenses. If like property manager salary should go to direct cost. Because of their direct contribution, you are generating this revenue. But the salary of the security guard or the salary of the supervisor or some other staff, finance team, their salary cannot be direct cost. Their salary will be expenses. This is GP only at this level, and that is more deeper. Now accuracy will be same. The level of depth. Now I want to ask you a question. Now my GP is 70%. How much is my cost percentage?
25.
25? From this
30%.
will be 30, right? Now the percentage in decimal format, if I to write
0.7.
0.7. So the cost will be 1 minus 0.7, which is 0.3, and that is 0.3 into 100. Clear? Same story here. Now sometimes, anyway, you may not going to appear exams, but if you happen to, they may ask you what is the salary percentage? What is the depreciation percentage? Then you have to take that separately and then divide from sales. And then, so this is number 3. We have another important ratio, number 4. So can I erase the board? Using your available assets, how good you generating revenue. So, turnover over total assets. Remember, this is not in percentage. This is in times. Every $1 of my asset, for example, my turnover is 100, my asset is $10. So my answer is 10. Interpretation is every $1 of my asset, $10 of revenue I am generating. So I am that efficient. So this is known as asset turnover ratio. Sometimes we say that ATO. Now we are going to go into another important concept. We call it DuPont analysis. I will multiply by NP. What will I get? What is my ATO equation? Turnover over total assets into what is my NP equation? Net profit over sales. You see, sales and turnover are both same. So I can here substitute this word with and into 100. So what's going to happen? So then NP over total asset into 100. Remember, normally when we say NP, that is always profit before interest and tax. Normally. Unless it is specifically defined in the context, when someone says you net profit, that is profit before interest and tax. So when I do the substitute profit before interest and tax divide by total asset into 100, did we learn an equation? What was our very first equation? ROCE. ROCE is profit before interest and tax over total assets into 100. What I am trying to mean, ROCE asset turnover times NP. This is what DuPont analysis means. It will branch out into two different segments.
Turnover as a
Sales.
Sales.
Net to net.
The capital employed and the total asset sale.
because honestly you said PBIT by capital employed.
Yeah.
not.
Yeah. The total assets is capital assets, capital employed. So these all are part of profitability. Now we can move on to the second segment of it.
It's the number divided by total assets.
Yes.
The assets per the number, how you define?
That's what I told you. Every single dollar of your assets, how many dollars you are generating as your rental income from your business point of view.
Regardless of the expenses.
Pardon?
Regardless of the expenses.
No, we are not looking into expense. Top line.
Okay.
Top line is your rental income.
Assets
You are-
against revenue.
Exactly. You are utilizing this asset and how efficient in generating revenue. Then in generating revenue, you may have to incur expense. You need to have staff, pay salaries, you need to have maintenance, then you need to incur related expenses, you need to have overheads like this utility and that and this, which you need to pay. But top line against the availability of your assets.
This profit before interest and tax is the same EBITDA.
EBITDA is different. EBITDA earnings before interest and tax, depreciation and amortization. These two terms are addition. That is even more fine-tuned term. We will use this for specific performance analysis. In profit before interest and tax, depreciation already deducted before. So that means I need to add back depreciation. And also I need to add back amortization. Every one of us now know what is amortization. This is an important tool. But we will, I never thought of discussing that in this scenario. So this is all profitability. Now let me move on to the second one, liquidity. Can I take off everything? There's a ratio called current assets ratio. Sometimes we write simple, straightforward. Current assets over current assets. Now, in your notes, if you go back, you will see that balance statement of financial position. I have shown you. There you can check. The previous one, previous page. Here. Now in this, you see you have a subtitle here, current assets, million. And then also you have feed down current liability, you have 4 million. Now for you to calculate current ratio, what you do is, you put 6.4 million here and divide that by 4 million. So as long as your answer is more than 1, you are healthy. What this interprets, for to settle your $1 liability, I mean current liability, how many current asset, how many dollars of current asset you have? So what is the answer? I believe, let's say 1 point something, right? 1.3? 1.26, okay. So 1? Okay. So this is what my current ratio, meaning I have $1.21 of current assets in my pocket to settle $1 of current liability. Suppose if you have settled all the liability, would you be still healthy? No. You have 1.21 with you. You need to settle $1.
Yes,
So
that's what
after
I have
settling,
one, yeah.
you still have 0.21 with you, right? Meaning you are healthy. So that's that liquidity that we are looking at. Are we that liquid in managing our business? There are some benchmark here. We have manufacturing, we have service, we have finance or banking. The current ratio for manufacturing should be, meaning to settle $1 of liability, minimum you should have $2 of current assets. Why? Manufacturing always will have inventory. Out of these $2, $1 should be inventory. So when you go to service, what you are missing in service compared to manufacturing? You don't have inventory. So the benchmark must be $1 of current assets enough to settle $1 of current liability, meaning you are healthy. This is at least minimum. When you go to finance and banking, the funny part of the story is they are living with others' money. Agreed or not? Agreed. So what happens is that, so you got it, you guessed it. To settle $2 of liability, at least if I have $1, I'm happy. Whoever studied economics, you probably have studied something called credit multiplier. Exactly. So how good the bankers or finance company is, how much they can please the customers and bring all the deposits, and keeping $100 deposit, how clever they are. They may give loan $1,000. Possible or not? Very much possible. So what they do? Mr. A, he comes, he gives deposit of 100. Then Mr. B comes, they give 9. And this Mr. B goes to bank C. He will deposit that 90 or 80. And if you really work out and see, at the end, the bankers will have more liabilities. And also from a financial management point of view, please remember, always bank wins. We as customers, we always lose. Foreign currency. Now, Qatari Riyal to, let's say, British pounds or euro. Now, if I to buy from the bank, I have to pay very expensive. If I go with the currency and sell to the bank, they will take it as very cheap. Always I will lose. Can I argue? Can I fight? Nothing I can. So this is the way the economic setup is. There is a federal bank. That's the original concept of central bank, started in US. The concept of federal bank. Actually, I saw one video of a leading economist from US. What he is saying, first, to make economy healthy, you have to demolish the federal bank. But the inside the story of federal bank, there are 10 huge rich people has gone to a resort, stayed in that hotel or resort for 2 weeks, and they thought how to put the general public in trouble. On that their idea only, the federal bank came. And that has been replicated to worldwide. Now every country believe they are so-called the best expert people who help in the country. But you really dig into deep, everyone losing our funds towards that. But as long as that central bank funds are helping the country to grow, we are happy. But unfortunately, country like Sri Lanka is totally opposite. I cannot comment on Qatar. Maybe they are very good, but at least my experience back in our country is this. So this is the benchmark for current ratio. Manufacturing company 2:1, service company like you guys 1:1, and finance or banking sector 1:2. If they are like 4, they are even nafar karbata maximum. So there is something called one more equation.
Contractors here are kind of manufacturing.
No, contractors are service.
Service.
Yes, yes. Quick. Ratio. Extended version of this. Here what we try to measure, from my current assets, if I remove the inventory and then I compare with my current liability, what is the status? That is what you call quick asset ratio. We have a different name, asset test ratio. We call it asset test ratio. So quick asset ratio, another name is asset test ratio. Equation is this: current assets minus inventory divided by current liability. Two ratios comes under liquidity. If we are strong or positive in this, that means our business is healthy in terms of liquidity. But you remember that triangle: profitability, liquidity, and solvency. We should evolve among these three. So this is the second category, liquidity. So I can move on to the third category, unless you guys have any questions.
This quick asset ratio is used to derive what?
To find out how fast you can get your funds, leaving inventory out. That's the understanding. All these equations and ratios are there in the book. That's why I deliberately don't want you to take notes. Efficiency ratios. Also, we need to find out how efficient we do in the business. Before I go to this, I would like to talk about something called that video they spoke about. I would like to add some additional information on this. There's an equation for this. To calculate working capital, can you tell me? I'm pointing my Sri Lankan friend. If you don't tell, please it export on Sigma. So the equation is current assets. Can you calculate? Working capital is equal to current assets minus current liability. And there is something called cash operating cycle or working capital cycle. This one I believe you understood. Now what is this actually? how soon you are able to generate cash by evolving in the working capital cycle. Before I give the answer to this, I now come to these ratios. The very first ratio, inventory retention period, meaning from the day I have the inventory in my warehouse, this is my warehouse and this is the customer point. Now I do the purchase and then I do the I sell. Now from this extent to this extent, how many days I am keeping the inventory from the day I purchase till the day I convert to sales? That's what the inventory retention period. How many days I am keeping? Now, do you think keeping the inventory in my own warehouse is a costly exercise or free exercise? What are the related costs you think?
Overhead.
The storekeeper, security, also you know the reps and mices. Those fellows will come and then they will, if it's a food item, it's a very huge difficulty. So you need to have a pest control. And also there is something called pilferage. Any one of you have worked in food industry before? I have some experience in Doha. I will not tell the name of the company. There are storekeepers. They are into mainly selling oil, the can oil, 40 liter, 80 liter, like this. The cooking oil, and also rice, sugar in bags. So these storekeepers, what they do, while they are busy working, they go and give a football to the oil can. And the oil can will have a smudge, leave it as it is. In the evening around 6 p.m., he will carry that can, go to the storekeeper manager, sir, see this got damaged, what shall we do? Then he will ask, if some of our staff want to, then with the staff discount, give it. So he will himself purchase that. What do you think? Is it part of pilferage?
No, please.
It is a huge pilferage.
Huge.
But
you
the
shouldn't
company
be.
don't know.
Yeah.
And you know the unfortunate scenario, some of them, I know personally, they come and talk like a big achievement. I have done this, I have kicked the oil can and then that got damaged and the company gave me as a staff discount with 40%. From our perspective, it's haram. But they do, people do. So, in managing the inventories in warehouse, there are so many different expenditures. This expenditure, we have a professional term. Holding costs. Because I need to pump my own money in keeping this inventory. That money I could have deposited somewhere else and earn some interest from a business point of view. Which I am not doing it. What I am doing, I am this week also we have a different name for that. Capital tied up. That amount of capital is tied up in the form of inventory. So we need to understand how long the period that we are retaining. We have to very fast converting the inventory into sales. So equation is average inventory divided by cost of goods sold into 365. Now there are some additional nitty-gritties here. When I say average inventory, year 1, year 2, year 3. Let's say I am comparing these two, year 2 and year 3. So I have inventory here, here and here. So when I need to calculate average for year 2, let's say this is 100, 120 and 80. For example, for me to calculate the average for year 2, what I need to do? So what do normal mathematical average is, take the total of these two and divide this by 2. So 100 plus 120 divided by 2, you get 110. This is for average for year 2. What about year 3? 100, right? 120 plus 80 divided by 2. When you have minimum information, you can calculate average. But what happens if you face a situation when you don't have year 1 data? You only have year 2 and year 3 data. Then can we calculate average? We can calculate average for 1 year. But other year we can't. So if you face this situation, don't calculate average, use the data as it is. So this is one nitty-gritty. Other nitty-gritty is about cost of goods sold. So what do you mean by here? There is an equation. Opening stock plus purchases minus, this is the equation for cost of goods sold. But if you don't have enough information to arrive cost of goods sold, then you should use purchases. So this much additional information are really needed when you are really digging into this area. But I have given you for your sake of your good information. That's all. So this is inventory retention period. Third one, inventory turnover. Actually, this is inverse of this. When you say inverse, cost of goods sold divided by average inventory. But one difference, I will not use this, and the answer here is in and one another factor about this 365 before I come to this. This if you multiply by 365, your answer is in days. But if you do multiply by 12, your answer will be in months. If you do multiply this by 52, your answer is in months. Now here, what we try to understand here, from the available amount of inventory, how strong we in converting that inventory into sales. In second one, can I erase all of this? Are you having struggle with your customers in collecting funds? So this is one of the important ratios. Average receivable divided by credit sales into 365. Some of the factors. Average, same information what I told you. Minimum 3 years information you have, you can calculate average, or minimum 3 months, or minimum 3 weeks. What about why I put a bracket in this credit? The correct equation, you only need to take the credit sales. But if the question gives you total sales, what you need to do, you need to find out how much case sales and then take the credit sales. But if they don't give you this, you're going to sleep, what you do? You take the total. So what is the interpretation? What you get from this? How many days? This is the day we sold. This is the day we collected. So this gap. How many days I had to wait in collecting my money? Is it worth giving this item on credit to this guy, or without doing this sales, I go and invest that money in the bank and receive interest and sleep at home? Is it good?
In this case, I'm always trying to project this on what we are having. Actually, we are sitting on the other side of the table. We are the one who is paying. We are the one who is getting the credit. So we have lenders who are dealing with us.
There is something, then I am coming to the next one, payables ratio.
Okay.
This is receivable now. So you are real estate operators, correct? So you have land loads, if I understood correctly, and then you have tenants. Am I right? Is what the situation is?
I'm the landlord.
You are the landlord
And I'm the operator.
and you are the operator. So there is no difference between these
Yes.
two. So this is one box, and then you have tenants. So then you
I'm
have to
getting-
collect money.
I'm getting the money in advance. There
You
is
collect
nothing
the money in advance.
credit.
So then there is something called deferred revenue. Like for example, what happens is you get the 12-month check.
Yes.
12-month check, PD check or the very first day cash check.
No, PD check.
PD check. PD check accounting concept is different. Now let's say 10,000 real is the rent.
Yes.
And if you receive 120,000, but dated for 12 months.
Yes.
Now, can you consider 120,000 as the rental income for the month of January? No. If you do that, that's a big mistake. So, every month you will take 10,000 like this. Then what is the issue you are talking about?
No, what I'm saying that but I'm having agreement with contractors. Okay, for doing the maintenance for
Yes.
with the credit.
Ah.
So I got the materials.
That is
and then I
payable.
pay. I pay.
Yeah, you
after.
say that, okay, guys, you give me the material, I will pay you in 2 months, 3 months time.
Exactly.
So, then I am coming to the next equation. So, this is receivable.
That's why when we delay in the payment, this may result in some complications in the,
Yeah,
in the operation
efficiency
itself.
will be you know, the how efficient you manage your funds will be a problem. And there is also, later I will come to that, but I will tell you now, there is something called COD, cash on delivery terms. If you try to drag with your suppliers, they will say, my friend, go to hell, I'm not going to give you, you pay me cash and take it. Then you will struggle or you will stagnate. Now, what I am referring here is the receivable. So this is the second or third equation under efficiency. The fourth one, yeah.
For us, for our business model, what we can deduct from this standpoint,
Yeah, now, if I understood from Mr. Haitham, what I understand is that, so you as the operator or the owner, and you have the customer is paying all your rent in advance.
checks.
Yeah, checks or cash, but in advance. So, for example, January month rent, you will not wait until 31st of January. On the 1st or 2nd of January, you will deposit the check. Money will come to you, then only you will allow the tenant to stay there. Correct? So, if you reach to month of, for example, December month rent, you have received the order. Correct? So, when you reaching here, on 31st December, you have received all your rent. So there is no payable to your tenant. But if you have a practice of taking rent for January rent, you are taking in the previous year December. If that is the practice, that means you will take how many checks? You will take 13 checks. Now, 2024 January, you receive the check in December 23, and it will go like this. And the December, when you come to this December, you have received the check for 2025 December. Sorry, January. So that means 1 month check will always be known as deferred rental for you. It's a liability for you. So there is no possibility of having a receivable from the tenant unless the checks are bounced. Then you have problem of going to courts, and that's the different scenario. Now we go to 5, right? So 5 or 4?
4.
4. Payable, repayment, date. Average payable divided by credit purchases into 360. This is what you are doing. To your contractors, your maintenance people, your outside suppliers or whoever, you will calculate and find out how many days. The company may have policy, 30 days. Like for example, if you sign up a contract with Qatar Energy, they will always say that minimum 60 days you need to wait. I have supplies with Aspire Qatar, Aspire Zone, or sorry, Espitar Hospital. I am outsourcing manpower. I have some team I am outsourcing there. When I send invoice for month of January, I will be submitting on 3rd, receive the payment on 1st of April. No, 90 days. I have to beg also. Please, release, I have cash flow issue. I have to tell all the stories about under the sun and the moon. Only to receive my right. It is with government. So with private people, you can understand. So payable, this is also will help you make your business more efficient. If you really have cash flow, which you don't need to, now if you try to drag the days, the supplier is not idiot. He will increase the price. So try to bargain with him, you reduce the number of days and to cut down the margin. You know, there is something called cash discount, incentives, which you can talk about. So also there is a working capital management question to compare, is it worth taking credit or borrowing money from the bank and settling him upfront? You see, there is something called cost benefit analysis. So this is payable repayment. But again here there are mitigation, like if you cannot calculate average, take the purchases. And then if you don't know how much is purchases, remember this. Cost of goods sold is equal to opening stock plus purchases minus closing stock. If they have given you this, and if they have not given you this, and if you have information of this too, you can arrive that. But if you don't have this data, simply take. So now we can go back to talk about cash, inventory days, inventory will get converted to receivable, to convert it to receivable, you should have credit sales, correct? From inventory, for you to convert that to receivable, you must do credit sales. If you do cash sales, you will have cash. And from receivable, if you collect from customers, that receivable will convert to cash. Then, if you do cash purchases, that will again convert to inventory. But if you do credit purchases, that will convert to creditors or payable. And when you repay, when you do credit, I have made a small mistake. This is repayment, I'm sorry. And this one, credit purchases. And this cycle is known as operating cycle or cash cycle. And mathematically, you can calculate inventory days plus receivable days minus payable days. This is cash cycle. So this is all about efficiency. Now we need to talk about long-term or efficiency or short-term solvency. Now we need to talk about long-term solvency. Any questions so far? Am I leaving any one of you in dark? You are okay, brother? Good. So let me erase. Now we go to long-term solvency. That is very common term. Everyone knows. In our day-to-day life, gearing. What do you understand when you say gearing? Everyone driving here, right? So from a driving perspective, when you say gearing,
Safety belts.
but what I will understand, I will go fast. Gearing and
Okay.
if I am driving a manual car, change my gears and then put to top gear and then I will.
Okay, that is a technical usage, but when you
Yes.
say in the word,
Very correct. Also there is a different English phrase. Driving but kill. One perspective. The other perspective is driving kills. Yes, I know kills, but still. So two different type of people are there. They don't care. How many of you have driven in Riyadh? The city of Riyadh? And experience, you have only 3 lanes and you will have 5 vehicles. And other funny story is, you will have, let's see, you cannot wait there. You need to go this way. That's the rule of the Riyadh traffic system. Very difficult. Many times I have gone and I have experienced that. Doha is one of the safest driving routes. Even Dubai is good, but Doha best.
You have to come to Egypt.
Inshallah. Still planning to visit. Yes. So need for speed, yes. So anyhow, come back to gearing.
There are no lanes there. There are no lanes.
And jiddan mas buta. And jiddan wala giddan. Giddan. It depends, huh? Jawabul Guma, ana surtu Gamal. Yes, he is Egyptian. So he will kill me after I go out.
Yeah.
Anyway, gearing ratio. When you talk about gearing, there are two main ratios. One is gearing ratio itself. That is debt divided by debts plus equity into 100. Now, what is debts? So far what we learned, debts means long-term liability or non-current liability. So non-current liability divided by non-current liability plus equity into 100 will give you gearing ratio. What we try to say, an example. In that 500, 300 is capital or owner's capital, 200 is loan capital. Now for me to calculate gearing ratio, 200 divided by 300 plus 200 into 100. So 200 over 500 into 100, I believe answer is 40%. Now having gearing is healthy or unhealthy? What do you think? Can we say in a flat to any company, you must have gearing? Can we say that?
Yes.
Yeah, that if the company's profitability is very high and you have alternative source of investing your own capital and your borrowing cost is very low, better you borrow and use your equity somewhere else. But if the profitability is very low and the inflation is very high, cost of borrowing also very high, better not to borrow. So just by having a 40%, I can't say this is good situation or bad situation. It is depending on the company to company and the surrounding economic environment of the business. Clear? So this is gearing. There's another ratio here. Debt to equity. Sometimes we say DE. Now from the same example I can work it out. What is that? Debt over equity. And remember this one in percentage. But this one in times. Meaning 200 divided by 300. That is 2 over 3. So, but same interpretation. Meaning every $3 of my equity, my business is comprising $2 of debts. Third one, so one is gearing ratio, other one is debt to equity ratio, third one interest cover. Now, if you borrow, you need to pay interest. Paying interest is good or bad? It's bad. No, there's no difference. It's bad because it's a loss expense for us. So minimizing the interest is good. How I minimize? One way, I reduce the interest cost. Other way, I increase the profit. Leaving the interest as fixed, and if I can manipulate my profits, much better. Now, all of you, I think most of you know cricket, right? They wear these pads. When the bowler hits with the hard ball, and because of the strength of that pads, his legs are not hurt. So there's a coverage. There are other coverages also. So that's the same thing with interest cover. How strong your profits to compensate and cover your interest cost. Equation is profit before interest and tax over interest. Again, answer is in times. So this is interest cover. So these are all about long-term solvency. The last but not the least, capital ratio. MPS, meaning market price per share. Here we don't calculate. What we do is we go to Qatar Exchange, QE. And have you seen that near the opposite to Toyota Tower, there is a Doha, the group. On top you see that the numbers are going. That number is market price per share. There is a huge mathematical calculation behind an engineering activity which we don't need to know. They will come up with that answer. So that is the first ratio which we don't have equation. Second ratio, EPS, meaning earnings per share. How I calculate this? Profit attributable to ordinary shareholders divided by weighted average number of shares during the year. This is the lengthiest equation, but in simple, profit divided by number of shares. But the correct one is this. So now we need to understand the meaning of this. Do you know what the meaning of ordinary shares? When you talk about shares, there are two types of shares. Preference shares and ordinary shares. To give you an example, at home, dinner or lunch, when normally in a normal house, mother cooks the meal. And what she does, she keeps a fixed portion of that meal to her husband, meaning the father. Normally every day, average will be an equal size. And when this guy goes home, he knows he has this 1 or 2 plate of meal. So that type of share is known as preferred shares. Meaning these shareholders will receive a fixed dividend for the contribution they are making to the company. There is a huge discussion, I don't want to go into that. But when you talk about ordinary shares, now coming to this example from the home, so okay, then she has kept a portion to husband and that will be preserved. She will not allow her children to go and touch. Then she will call all her children. She will feed. One children will eat a lot, other children will eat small. Will she bother about how much she should eat? Normally. She will not bother. But after all the children finished eating, she will then look into the pot. The situation is, if this is the pot, some circumstances, only this much will be left. She has no choice, she has to eat. But in some other circumstances, all this will be left and she cannot throw it away. Because she is the one who cooked, so she has to eat and finish. So, either situation, the ordinary shareholders are who contributed to the company with taking the complete risk, whether making profits or making losses. Now, even the companies to make loss, they cannot tell the staff, look, the company is suffering, so I will not pay you salary. Or they cannot tell the landlord, I'm making a loss this month so I don't pay the rent. Then no one will listen. But he will have to accept. So that is ordinary shareholders. So the earnings per share we calculate for ordinary shareholders. So what is the meaning of the word profit attributable to? The amount, as I explained to you here, what is left after giving to every other stakeholders, tax department, employees, any other government, suppliers, and so on. What is left is the profit attributable.
The part of it, the salaries, this is not part of the profit. This is from the expenses.
Correct. Yeah, that's what I'm saying. Now, when you talk about income statement, so you will have here profit before interest and tax. But before you come to here, the salaries will be here. So I'm talking about something down here. So you will start from the top line, you will deduct everything. That's what I'm saying from this example. So that is profit attributable to. Now what about this? Weighted average number of shares outstanding during the year. Look into this simple example. 1 January, 31st December. Let's say I have number of shares 100 on 1st January. On 31st December also. So what do you think my average shares? How I calculate? 100 plus 100 divided by 2, right? Which will be again 100. No change. Well and good. We are happy. The second situation. 1 January, 1 July, 31st December. 100 here. I issued extra 50 shares on this date. Now 150 here. Now I need to calculate average. I can't do like this. 100 plus 50 plus 100 divided by 3. No. What I have to do, I need to look into the number of months. So here 100 times 6 over 12 plus here 150 times 6 over 12. So this will give my weighted average number of shares outstanding. In short, in simple, that is EPS. So second one, third one. Dividend cover. We just talked about interest cover. Similar thing. Profit available for distribution. See, I cannot pay dividend for profits which I cannot distribute. Divide by dividend. That will give me this. So 1, 2, 3. So we'll move on. Any doubts on this? Or is that okay? Can I continue? Oh. So the next one will be public school. Dividend per share. Meaning total dividend divided by number of. And then we have something called dividend yield, which means DPS over NPS. Dividend per share is this. NPS we know. So this is dividend yield. This much is the total amount of ratios. And I have one case study also. I will give that set of questions. We will continue this answer to that in the next session. What's the time now, by the way?
4:15.
4?
4:15.
34?
4:15.
4:15. 4:15. We still have 20 minutes. Or we need to stop at 4.
I think we need to stop at 4.
Okay, sir. Okay, we will stop for the day. And I will meet you on the next Saturday.